For many people thinking about retirement, it's axiomatic. Pay off that mortgage on the house. Well, it might be wise to think through this strategy a little more carefully. For why, we turn to private wealth advisor Thiago Glieger of RMG Advisors. And Thiago, it always seems natural, get rid of the housing expense and pay off the house, but maybe not the best idea always, is it?
Yeah, I think it's one of those things that with most retirement planning, with most financial planning, what seems to be good for one family isn't always the best thing for another family. And it's kind of against the grain because in medicine, we think about, there's a certain symptom that's met with a specific treatment or medication or whatever. But in financial planning, we start to recognize it doesn't quite work that way. So you have to be careful and look at your own circumstance very objectively. But what doesn't help is the fact that all these pundits are often talking about you can't have any debt to your name. Liability is bad, 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 bad. You need to pay off your mortgage before you head into retirement. And so people start to have this ingrained idea that they can't retire until they do so, or going into retirement with a mortgage is a really bad thing.
But a mortgage has characteristics, and homeownership have characteristics that are different from other kinds of debt. And that's the crux.
That's right. Yeah. I very loosely categorize debt into two different categories, one being good debt and then bad debt, right? Bad debt is that little plastic card everyone has and overuses. If you're carrying debt on that, that's not good. Good debt, you can use leverage to have your money, grow it for your retirement, continue to allow it to support you, but you also get to have something like a house and live in it, and that house gets to appreciate in value. There's some tax properties that may be beneficial for you about having a mortgage, so it can be done correctly.
Because, yes, the mortgage interest is deductible still under federal tax law, and so if you lose that, you could have a greater tax liability from whatever income you have when you do retire.
That's right. And I think a lot of people kind of forgot about the deductibility of the mortgage interest because standard deduction amounts have been so high. So unless they're itemizing, they may not be getting that benefit. But I have to remind people that in 2 years, the law is set to go back to the original rule where, again, deductions will go down. And unless they change the law, that could be a very beneficial benefit for people again.
And people sometimes think, well, I'll pay off the house, realize the appreciation, and there's a pretty hefty capital gains avoidance that you have. Most normal people with normal houses will be under that limit. And then buy a condo, and then still I'll have space I want and live rent-free. Well, not so fast there either.
Right. And you always have to think about what are you trading for that liquidity. The paying off the full mortgage or just paying cash for another property and just having no mortgage at all, like something for a condo, for instance, you're trading that liquid capital for illiquidity in real estate, as well as some reduced expenses because then you don't have that mortgage. But if you think about also what is the composition of a mortgage, it's not entirely just the loan and the interest payment that you have. There's really 4 parts to it. We call that PITI, right? Principal, interest, taxes, and insurance. So even in your case, when you're describing a condo, somebody may not have a mortgage payment, but you're going to have HOA fees, you're going to have condominium fees, you're going to have the taxes and the insurance that you still owe each month.
Right, and sometimes a condo will come to you and say, guess what, we need a new roof. It's $2 million, but we only have $500,000 in escrow for the roof, so everybody gets assessed umpty-ump $10,000 out of nowhere to make sure the place doesn't fall apart.
And that number is not out of the ordinary. I had a client just a few months ago come to us for $15,000 out of nowhere because, again, it was that situation where they needed to replace everything throughout the whole building, and it was a huge assessment.
Right, and especially in the age after the collapse of that condo in Florida, nobody wants to take chance with a condo building if it's more than 2 stories high.
That's right.
We're speaking with Thiago Glieger, wealth advisor with RMG Advisors of Rockville, Maryland. So let's presume then that someone nevertheless wants to pay off their mortgage. What's a good strategy for doing it? Where do you get the money to do it?
There's a couple of questions I would want people see themselves asking. And really the first is, if I do this, what are going to be the tax implications? Right? If I'm going to take a large lump sum payment from my retirement accounts, that's taxable like salary, just like ordinary income. And so the additional question here is, beyond just the taxed cost, how much potential future growth did you also cost yourself by not having this money anymore? Does this create any kind of risk in later retirement because it's a huge chunk of money that you're not paying? So then other people may look at non-retirement accounts like individual accounts, brokerage, joint trusts. That comes with capital gains. So you have more control and it is less taxes than ordinary income. And then sometimes people will say, well, you know what? This is what we have the Roth for. The Roth is totally tax-free. It's for surprise bills like this or something we can use and we don't have to worry about the tax. I don't like people using the Roth for something like this because the Roth is where you get all of your tax-free growth. I'd like to see people using the Roth as kind of their growth vehicle for the future. So taking it and dumping it into a house may not be the best thing, but that's usually the three options that people have, right?
Or you could win the lottery, I suppose, and then it doesn't matter what happens. But if you do then retain your house and the mortgage payments, I mean, if you can afford them, the question is if you can afford them before you retire, can you afford them after you retire, that PITI payment? And that's really the analysis you have to do, because it might be that you can totally handle it.
That's right. Exactly. And that's the point here is I think a lot of people think they just can't have a mortgage payment because their FERS and Social Security is not making up all of the income that they had from their salary. So they think, oh, well, our income is going down, so we must reduce our expenses. And that may not necessarily be true. If you've been a good saver throughout your career, then you might be sitting on a substantial chunk of change that you can use to continue to grow and invest for yourself. It continues to generate cash flow so you can keep making those mortgage payments because you're still generating a retirement paycheck at this point. It's just not coming from the government.
I guess people might have the idea, well, we can partially pay it off with a chunk of the Roth or a chunk of the rainy day savings we have. But on the other hand, if you do that, you don't really change your PITI payment because the bank,
right,
the way they've rigged the mortgage system, you pay all this interest until you pay off the principal.
Right. And that's why people really look to do a full payment because you're only free and clear of those interest payments once you clear that liability completely. And again, the challenge in doing these lump sum payments is that it affects something called your adjusted gross income. And not only do you pay higher taxes potentially in that first year, you may have pushed yourself into a higher tax bracket for your first pension. So now there's a bigger bite coming out of your annuity as well. This can also impact capital gains taxes. It could impact your Medicare Part B premiums. There's a whole lot of other elements of a retirement plan that this one single move can have an impact negatively on. So you really have to be careful.
Most of the calculators online where you plug in numbers to calculate whether you can retire or not or what your costs will be, there's a lot they leave out. And one of the things they don't have is tax, because tax varies so widely by location, state you're in, municipality you're in, because property taxes vary and then state taxes, et cetera, et cetera. Are there any sources of information to model what your taxes might look like? If I stay in my house, I pay this, that, and the other for mortgage. Now here's my income, that type of tax analysis.
Yeah, and the challenge, Tom, is needing to know a little bit about how the tax structure works, right? And I always encourage people, if you want to do some of this work, you can actually just go to the IRS website and look up the tax brackets and say, okay, if I generate this much in ordinary income, what is considered my marginal tax bracket? That's the rate at which my next dollar is going to be taxed at. And this helps me to figure out if I take a lump sum for my TSP, that's what my tax picture is going to look like. And then thinking about, all right, well, if I do this for next year, is that a year that's going to be better for me because maybe I'm not working? Or do I want to do it this year because I have extra cash flow to be able to still contribute to the TSP even though I'm taking money out? So there's some modeling that can be done, but you're right. Depending on how you file your taxes, depending on how you're generating your income in retirement, which accounts you're pulling the money from if you're no longer earning a salary at this point, that's all going to impact what that bottom line is for each individual family.
Yes, because you have to figure in your Social Security payments in there because that's taxable, since 1980 they've been taxing Social Security income, which kind of sounds absurd since you paid 6% tax on your income for your whole working life, and so did your employer or employers, and yet it's taxable.
Yeah, it's tax on tax. And a lot of people don't recognize that. They think Social Security is not taxed, but a good chunk of it is likely going to be taxed because you've got a FERS pension that essentially puts you in that you've already started with taxable income, which means your Social Security will be too.
All right, so bottom line then, do some real analysis before you worry about paying off the mortgage on your house.
I really think it's good to do some sort of financial modeling on this because if you take out a huge swath of your money and now it belongs in a real estate property instead of your portfolio, what does that do to the longevity of your retirement plan?